Welcome to News.Markets. Well, history shows that stock market crashes tend to start in the autumn. 1929, 1987, 2008, they all kicked off at the same time of year. Perhaps it's because investors head off on summer holidays full of hope, but when they return to their dealing desks, they realise nothing much has changed and panic sets in. They call it the September effect, or amidst concerns about growth in China as they devalued the yuan, plus uncertainty on interest rate moves in the US and the UK. Global markets are particularly jittery. What does it all mean? Well, Ron William, Senior Tactical and Market Timing Strategist at the ECU Group, thinks this autumn will get another painful equity crash. Well, thanks for coming in. Now, what I want to know is, why do you think that financial markets are primed to collapse now?
This time is different in our opinion, and we think that partly because, of course, the market is so historically overstretched. It's 6.5 years in the running. It's very, very old in the tooth at the moment. But also, even if you just look at the last stretch that we've experienced, it's been over 1,000 days without just a basic 10% correction. So that really is unsustainable in the short term. That's one of our central points. The other thing is we're looking at a much larger cycle, something called the decennial cycle, based on economic models. And what that suggests is the years of 2016 and 17 are the big bear negative years. So we're kind of, it's kind of a rising wave of all of these different filters, all suggesting the end of this year and certainly into the year after and the next one after are going to be on the downside.
So all of these forces will collide, but how much are they impacted by concerns about growth in China, for example?
I mean, our team, headed up by Robin Griffiths, has always said that the growth in China has been so strong and it's just likely to be, the growth is likely to decrease a little bit. So instead of 6-7%, we're likely to see 4%, for example. So that will have a ricochet effect on the markets around the world. Particularly the mini bursting of their bubble, which was quite a strong move and did have a contagion effect. We're still very bullish on China in the long term, looking to buy on a new low in the market. But still, circling back to your point, there is an effect out there, and there are many more market fragilities, China being just one of them, Greece and Europe and many other things. We think the big kind of market fragility out there is the bond market, and that is likely to be the hair that breaks the camel's back, as it were.
So how should investors play it? Where do you see the opportunity?
Well, the opportunity is probably, I mean, to stay long on the markets that are pushing up to new highs. So certainly the US markets are the best of the West. But one of the things to keep in mind is maybe not to leverage at this point in time. There's far too much risk at these high levels. So maybe some astute risk management would be a smart thing to do. And then maybe, I think if you were looking for some safety, maybe in some of the government bond instruments, if you're looking for some kind of security. And then, of course, maybe cash on the sidelines for now, a certain small percentage of your position, so that you could then get in for a second go when the markets were to tick up again next time around.
So those traditional safe havens. But look, let's look at your worst case scenario. You think there are going to be 3 likely outcomes, don't you? The good, the bad, and the pretty ugly.
Yes, so not to sound, not to...
Okay, so the best of the bad bunch is the good. Who are you looking at there?
Yes, I mean, historically, stock markets tend to end in a very good way, and that is a big euphoric kind of blow-off rise, and that's where everyone's a buyer, but at the very end there's a fall, and that fall buys the last high, the price high. And unfortunately, the market then reverses. So the early stage of that is very bullish because you're seeing new market highs. The Nasdaq is a great case in point. It's a poster child for this example, because you've had major mega caps, tech stocks like Google and the such, which have runaway trends, and that is what's, the very few mega cap stocks is what's lifting this market higher back to its old 99.com levels. So the Nasdaq is likely to have the good scenario, but we think that there are other markets which will have bad and ugly scenarios. Bad would be a failed high, so a false high. People buy into that, and then the market might reverse. The Dow and the S&P might be examples of that. The performance has been flat year to date, so there's a lot of churning going on in those particular markets. And then last but not least, last but not least, they're very ugly, which is still a probability. That would be broader-based markets, which are already fragile and have been divergent for so long.
FTSE 100.
FTSE 100 is a case in point, but FTSE 100 for 2 reasons. One, it's been in a massive distribution pattern under the Y2K peaks underneath the 7,000 glass ceiling, 7,000 on the FTSE, but also because a large percentage of the stocks within the FTSE are commodity linked. And of course, commodity prices have been depressed for so long, that has had produced a lot of headwind on UK shares. So that it's already inbuilt into that market fragility and further downside in this type of scenario. Okay,
so a potential collapse in equity markets in Q3, and there could be some good, some bad, and some pretty ugly consequences. Thanks very much for filling us in.
Thank you very much.